Okay, so we have to talk about the oil shock is about to hit America because I think we're being lied to. We're told everything is fine, that inflation is cooling, that the economy is resilient. But if you look at the numbers, like really look, you see something terrifying. The U.S. Strategic Petroleum Reserve, our emergency oil stash, it's at its lowest level since 1983. Think about that. 40 years. And it wasn't just a slow drain. They dumped 180 million barrels out of it in 2022 to keep gas prices down before an election. They told us it was a temporary measure, a bridge. But now, with global demand projected to hit an all-time high of 103 million barrels a day this year, and OPEC Plus cutting supply, the SPR is still critically low. If you see that once, it could be a coincidence, but it's happened 3 times. The draining, the demand spike, the supply cut. Welcome to the Alpha Brief. I'm Reid, and if you're new here, we follow the money so you don't have to. Today, we're going to expose how a looming oil supply crisis, driven by deliberate underinvestment and geopolitical games, is about to fundamentally reshape your financial future. Now, why does this matter to you? Because an oil shock isn't some abstract market event. It hits your wallet directly, impacting every facet of your daily life and long-term financial planning. If you own a home, your mortgage rate is already high, and it's about to feel even tighter. The Federal Reserve, tasked with fighting inflation, will likely respond to surging energy costs with even higher interest rates, making borrowing more expensive across the board. That means your adjustable rate mortgage could climb, or refinancing options become even less attractive. If you're carrying any credit card debt, those interest rates, which are often variable, aren't just going to stay high. They're likely going to climb even further, turning manageable balances into runaway burdens. Every dollar spent on interest is a dollar not saved or invested. Your grocery bill already makes you wince at the checkout. Prepare for even more pain. Transportation costs are a significant component of food prices, from farm to processing plant to your local supermarket. When oil prices skyrocket, so does the cost of diesel for trucks, ships, and trains, directly translating to higher prices for every single item on the shelves. Your weekly food budget will stretch even less. And if your paycheck hasn't moved much in the last few years, the real purchasing power, what your money can actually buy, is about to get absolutely decimated by the rising cost of everything powered by oil. Wage growth has struggled to keep pace with even moderate inflation. Imagine the squeeze when energy costs surge. Finally, if you're saving for retirement, your 401k, your investment portfolio, is about to face a massive headwind from an economy squeezed by runaway energy costs. Corporate profits will be hit by higher input costs. Consumer spending will decline due to reduced disposable income, and market volatility will likely increase, eroding your hard-earned savings. Okay, so let's zoom out a bit and talk about how we got here, because this isn't just bad luck. This is a story of converging forces, some intentional, some perhaps misguided, but all leading to the same cliff edge. For years now, there's been this push, a global initiative, to transition away from fossil fuels. And on the surface, that sounds good, right? Cleaner air, sustainable energy. The International Energy Agency, the IEA, has been a major voice here. Back in May 2021, they released their Net Zero by 2050 roadmap, explicitly stating that there is no need for new investments in fossil fuel supply projects. No need for new investments. This wasn't just a suggestion. This became a directive, an ethos adopted by major financial institutions, by governments. We saw environmental, social, and governance (ESG) mandates become central to investment decisions. Banks like HSBC, for example, publicly committed to phasing out financing for new oil and gas fields. JP Morgan Chase, while still a major lender, has faced immense pressure from activist shareholders and climate groups to reduce its fossil fuel exposure. The U.S. government, under the Biden administration, paused new oil and gas leases on federal lands and waters early in its term, sending a clear message to the industry. Now, this sounds noble, but it had a very real, very predictable effect: a massive multi-year underinvestment in traditional energy infrastructure. The oil and gas industry responded by cutting capital expenditures. They weren't funding new exploration, new drilling, new pipelines, because the signals from regulators, from lenders, from investors were clear. Don't. Global upstream oil and gas capital expenditures plummeted from over $700 billion in 2014 to around $300 billion in 2020. And while they've rebounded slightly, they're nowhere near the levels needed to maintain sufficient supply. This isn't just theory. The American Petroleum Institute, the API, repeatedly warned about this, citing regulatory hurdles and a lack of clear, consistent policy signals from Washington.
Mike Wirth said, and I quote, "The system is tight. We've gone from a market that was long crude to a market that is short crude."
Said that a year ago, and it's only gotten tighter. And remember, it's not just the US. Global oil demand, after a brief dip during the pandemic lockdowns, has roared back. China's reopening, increased travel, industrial recovery, it's all pushing demand higher, faster than anyone anticipated. India's burgeoning economy and growing middle class are also significant drivers. The Energy Information Administration, the EIA, projects global demand to reach record highs, hitting 103 million barrels a day this year. So you have falling investment on one side, surging demand on the other. That math just doesn't make sense if you want stable prices. It leads to a widening gap, a deficit that has to be filled. And when it's not, that's where the shock comes in.
Fatih Birol said, and I quote, "The world needs to rapidly accelerate the clean energy transition, but it also needs to ensure secure and affordable supplies of oil and gas during that transition."
That quote from the IEA's own executive director highlights the fundamental dilemma we face. We're in a transition, but we've prematurely choked off the supply of the very energy source we still rely on for over 80% of our global needs. This creates a dangerous imbalance. So who set this up, and who profits? It's not a single shadowy figure, right? It's a confluence of powerful forces, and they all have their reasons. On one side, you have the climate activists and the politicians pushing for green energy. Their goal, from their perspective, is to save the planet. They genuinely believe that by making fossil fuels more expensive, they can accelerate the transition to renewables. But the immediate, unspoken consequence of stifling fossil fuel investment is higher prices for the fossil fuels we still desperately need. This creates an economic incentive to accelerate the transition, but it comes at a massive, immediate cost to the average consumer. Then you have the oil producers themselves, particularly OPEC+, led by Saudi Arabia and Russia. For years, they've been losing market share, seeing the West push for alternatives. Now, with Western companies constrained by ESG and political pressure, OPEC+ sees an opportunity. They don't have to pump at maximum capacity. They can strategically cut production, as they did just recently in April, announcing cuts of over 1 million barrels a day. Why? Because lower supply means higher prices, and for them, higher prices mean more revenue from less effort. They profit directly from the scarcity, consolidating their power and influence on a global stage.
Prince Abdulaziz bin Salman said, and I quote, "We are doing this to maintain stability and balance in the oil market."
Stability or strategic advantage? One of them is right. The irony is that the very policies designed to move us away from oil are making the existing oil producers incredibly wealthy and powerful, strengthening their hand, not weakening it. They're effectively being handed a monopoly by Western policy choices. Now, hold on. Who else profits? The banks that do lend to the oil and gas industry, but only to the established giants, not new exploration. They can charge higher rates, knowing the scarcity will make those projects more profitable. Energy traders and speculators thrive on volatility, and an oil shock creates immense opportunities for them to profit from price swings. The renewable energy sector, sure, they benefit from higher fossil fuel prices, making their alternatives more competitive. But that's a long-term play. The immediate pain is felt by everyone else.
Halima Croft said, and I quote, "OPEC Plus is clearly signaling that they are prioritizing market stability and price over market share."
Why now? Because the chickens are finally coming home to roost. The years of underinvestment, the political rhetoric against fossil fuels, the depletion of strategic reserves, it's all converging at a moment of surging global demand and heightened geopolitical instability. The transition to renewables isn't happening fast enough to replace the sheer volume of energy we get from oil. We're in this awkward, dangerous middle ground where we've disincentivized new supply without having sufficient alternatives in place. It's not just about crude oil supply either. We also face constraints in refining capacity. Even if there's enough crude, can it be processed into gasoline, diesel, and jet fuel? Many refineries have closed in recent years, and building new ones is incredibly expensive and faces significant regulatory hurdles. This creates another bottleneck, further exacerbating the supply crunch. Geopolitical tensions, from the ongoing conflict in Ukraine to simmering instability in the Middle East, add another layer of risk, threatening to disrupt existing supply lines at any moment. The world is simply not prepared for a significant supply disruption, and our strategic reserves, once our safety net, are dangerously thin. This isn't just a market cycle, it's a structural shift. The era of cheap, abundant energy might be behind us, at least for the foreseeable future. Understanding this reality is the first step to protecting your finances. You need to be aware of the forces at play, adjust your spending habits, consider your debt exposure, and reevaluate your investment strategies to navigate this new, more volatile energy landscape. That's all for this episode of the Alpha Brief. I'm Marcus Reid, and I'll see you next time.